Anjali ma'am, are you there?
Yes. Yes, I'm there. Thank you.
Good evening, ma'am.
Good evening.
Good evening, ma'am.
Madhurita, you may start.
Yes.
Nita?
Welcome back to all of you for the fourth session of the day. We are highly honored to have you here with us, ma'am, and I welcome you. Today, our expert for the session is Ma'am Anjali Tarpore. She is a distinguished macroeconomist and ESG practitioner, bringing over 27 years of experience in banking, finance, and sustainability. Having served in leadership roles within the HDFC Group, she has been instrumental in shaping investor relations, corporate finance, treasury management, and ESG strategies. A former executive vice president ESG at HDFC Bank, she has played a pivotal role in integrating sustainability frameworks into corporate strategies. Prior to this, she dedicated over 25 years at HDFC Limited, contributing to key functions such as microeconomic research, corporate lending, and investor relations. Ma'am holds a MSc in Banking and Finance from the University of Stirling, equipping her with a strong foundation in financial analysis and strategic management. Her expertise span microeconomics, corporate finance, and sustainable investing, making her a thought leader in the evolving landscape of responsible finance. Her journey reflects a commitment to financial excellence and sustainability, making her a valued voice in the intersection of banking, governance, and environmental stewardship. We welcome you, ma'am, for the session.
Thanks, Nivedita. I think I'll hire you to write my CV. That was a very generous introduction. But
Ma'am, it will be an honor.
just kidding. Great. Dr. Manvendra Pratap Singh, Mosami, Ghosh, faculty members, students, ladies and gentlemen, good evening. Thank you for inviting me to the Atal Faculty Development Program. It's indeed a privilege to have the opportunity to be a part of this wonderful initiative by the School of Management, NIT Roorkela. Having spent about 27 years in the corporate world, one recognizes how important it is for both corporates and academia to work closely with one another. And the reason why I emphasize this is because it is true when they say that the future of any nation is shaped in the classrooms. It is educational institutions like yours which helps instill the traits of being lifelong learners, always having a quest for deeper knowledge and then passing it down to our future leaders, in short, our students. So these are the skill sets that help to navigate in the real world, equip us with the skills of being adaptable in an ever-changing global scenario. As I understand, today marks the culmination of a very interesting and insightful week for all of you. The theme Earthwise, transforming climate action and sustainability for a better tomorrow, could not have been more apt for these present times. Over the week, I'm sure you've heard lots of sessions by experts who would have given you many interesting perspectives and raised some thought-provoking ideas. But what the world needs more than ever before right now is cooperation and collaboration. And much of this philosophy is in our very own Indian ethos, Vasudhaiva Kutumbakam, one earth, one family, and one future. This is a reminder of the shared responsibility that we all have for our planet, and equally important to recognize that climate risk has no borders. So let's address some fundamental questions of why environmental, social, and governance. Let's take an investor's perspective here. Now, a fair assessment entails analyzing both the financial and the non-financial parameters, which we often call as ESG. The financial and non-financial parameters on a combined basis is what gives us a holistic perspective of a country, of a city, and a company. And the significant change is that non-financial parameters is increasingly holding equal weight as financial parameters. So the non-financial parameters though they are very broad-based and priorities keep changing at different points in time. But the challenge is that we are still trying to determine how to ascribe a value to issues like shareholders' rights, board composition, ethical conduct, labor practices, risk management, supply chains, impact on communities, cybersecurity, climate risk, GHG emissions, biodiversity, and of course, the most topical issue of the day, ethical AI, among several others. These are all issues that fall within the ESG bucket. So from an investor perspective, many of these factors are considered, but ultimately the key question is, what is the return on investment? Now, there is sufficient empirical evidence to demonstrate that a tangible return on investment from a sustainability and ESG perspective is there. But conversely, there is also evidence that there are high ROI businesses that do not focus on ESG. And that's why there are no black and white answers here. But either way, sustainable assets today form a very, very large asset class. No, sorry, you know what? I thought I'd give you all a break from the PowerPoint slides because what I really want to do is to keep it conversational. So I'll share my speech with you at the end. Yeah, thanks. So as per the Morning Star, at the end of 2024, global assets under management were to the tune of about $3.2 trillion, which is about an 8% increase over the previous year. But in 2024 was also a year when we saw the lowest net increase into sustainable funds since the year 2018. Now, this decline was attributed to many factors, some of them being underperformance of sustainable funds relative to traditional funds, a political backlash against ESG, and increased scrutiny over greenwashing concerns. Now, many may ask, what is the ESG landscape going to be like in 2025? Will this be a make or break year for ESG? While some are saying that ESG is woke capitalism and probably needs to be dismissed, but then why is it that in many parts of the world, including India, we are seeing increased regulation and oversight on aspects of ESG? So in short, the ESG landscape has certainly turned more complicated. And this is why it's important to be able to deconstruct the many facets of ESG and understand them through various lenses. First, what is the science telling us? Second, what is the politics telling us on ESG? Third, what is the economics telling us about the trajectory of ESG? And finally, how is technology shaping the many aspects of ESG? So let's start with the science. And I'm sure throughout this week, you would have heard a lot of these people, but let me just put this on record. So we know that 2024 was the hottest year on record with surface temperatures at 1.6 degrees Celsius above pre-industrial average levels, which is the period 1850 to 1900. Now, just a few days ago, Copernicus, which is the climate agency of the European Union, declared that January 2025 was the warmest year on record, with the Earth's temperatures being at 1.75 degrees Celsius above pre-industrial levels. Now, this is despite having a La Nina condition, which is a climate pattern where surface waters on the tropical Pacific Ocean become cooler than usual. So now what we have on record is that the past 10 years have been the warmest. Now, the Paris Agreement of 2015, 10 years ago, set the global warming limit to well below 2 degrees centigrade and ideally would have not been more than 1.5 degrees. But this is likely to be breached. So as of now, the only way we know how to contain global warming is by drastically reducing greenhouse gas emissions. Recently, out of about 380 IPCC scientists, 77% believed that humanity was headed for a 2.5 degrees Celsius of warming. The bigger question now is what are the associated escalating damages going to be? And here are some numbers. Munich Re is a leading reinsurance company, estimated that global losses to the tune of $320 billion in 2024 was as a result of natural disasters. Now, this is a 30% increase over the previous year. So global insurers bore losses of $140 billion last year. These are humongous amounts. But what is worrying is that just 44% of these losses is covered by insurance. What this means is that there is a huge protection gap. India is no different. 2024, the annual mean temperatures rose by 0.65 degrees Celsius above the long-term average, which means that last year was the highest temperature recorded since 1901. Now, as per the Center of Science and Environment, India experienced extreme weather conditions in 322 out of 366 days in 2024, which means this is 88% of the year. And one's almost tempted to ask, is this a business as usual scenario? So with the science being very clear, it's important to also understand the so-called triple nexus of climate change, finance, and geopolitics. The science is very clearly telling us that climate change poses a huge financial risk. Now, the global risks report of the World Economic Forum, and I'm sure all of y'all would have seen that, they've been publishing this report for the past 20 years. Now, in 2024, 5 of the top 10 long-term risks are all environmental related ones. Now, because the risks to the financial sector are so much because of climate risk, global regulators have endeavored to ask banks and other players in the financial sector particularly to start disclosing and putting a framework of climate-related financial disclosures. The objective is to keep investors better informed of these risks. Now, the framework has 4 key pillars. It entails governance, which is actually asking the boards of companies to be able to be accountable for climate risk. They're looking at strategy. Strategy is what are the opportunities, what are the challenges arising out of climate risk and transition. Risk management, how are you mitigating these kind of risks? And then asking companies to have metrics and targets for their decarbonization pathways. Now, most central banks across the globe have mandated the TCFD framework so as to better align with their respective countries' green growth ambitions and net zero targets. But the outcome of disclosures of banks on the TCFD framework, even in countries where this has been mandated for a fairly long time, is still uncertain, and it's very clear that climate risk modeling is still in its infancy. And there is a lot more work, it is still evolving. The problem remains is the lack of standardization data and different assumptions being used, which makes inter-bank comparability rather difficult. In India, the Reserve Bank of India issued draft guidelines in 2 phases, but they've yet to finalize these guidelines. And one surmises is that the RBI may prefer to first have a green taxonomy in place prior to finalizing their guidelines. The tacit stance of the RBI has been that the establishment of a green taxonomy must fall within the ambit of the government and not the central bank. Now, other leading central banks like the Swiss National Bank or the US Federal Reserve has maintained that the primary mandate of a central bank is price stability and growth, and not to determine whether particular sectors or industries need prioritization. So surprisingly, yesterday, the media also reported that even in the European Parliament, the ECB, which is their central bank, said, and I quote, that the central bank needs to respect market neutrality and not intervene in markets by buying particular assets such as green investments, unquote. Now, evidently, we've seen a very, very different change. There's been a change in the political hue where there is a call not to favor particular industries, while the earlier intent was to facilitate and help this green transition. It's also true that many new age sectors have evolved due to incentives and subsidies being provided by the government. We've seen this work really well in India with the production-linked incentive scheme, which has encouraged the manufacturing of solar panels, EV components, batteries, fuel cells, among several others. Now, state governments as well as the central government have provided various tax SOPs, and these subsidies, we have to recognize, cannot run indefinitely. So governments, based on their fiscal positions, will need to keep evaluating the efficacy of such incentives. So evidently, policy making isn't that straightforward. The green transition will happen when there's a stronger coordination between monetary and fiscal policies and increased investments in green technologies. Now, politics and climate risks are very, very closely intertwined. And let me explain this to you. We have all known that 2024 was a year of mega elections. So nearly half of the world's population, an estimated 3.6 billion people, had major elections in the year 2024. Now, from a political perspective, the year 2024 across many countries, saw a huge anti-incumbency wave. And the biggest ask of the votary was for an ease in the cost of living crisis, which was triggered by high inflation, and an ask for better quality jobs. 2025 is the year to deliver on expectations of the voters, and this may be one of the reasons why we are seeing some element of a pivot in the perception of ESG across many parts of the world. But remember, no other macroeconomic variable hurts the common man more than inflation. Globally, central banks have been trying to battle high inflation, particularly post-COVID. And the two key triggers of inflation were higher energy prices and higher food prices. Take the case of food inflation in India. Now, a study by the RBI indicated that climate risks have become a dominant reason for rising inflation and rising food prices. Look at the period between 2016 and 2020. The average food inflation in India was 2.9%. This has more than doubled in 2020 to an average of 6.3%. Now, currently, as we speak, food inflation has tempered largely due to the good winter months that we've had, though vegetable prices still remain in double digits. The RBI has in fact said that climate risk is making food inflation endemic, which means it is going to be consistently present. And remember, high inflation rates prevent central banks from lowering interest rates. And we all know lower interest rates boost consumption, which leads to increased demand, which leads to revival of investments, better jobs, higher savings, and this is the virtuous cycle. So we've seen one reduction in interest rates so far after 5 years in India. And hopefully, one has to hope and pray that inflation doesn't play spoil sport in the year to come. So similarly, globally, the outbreak of two wars sent energy markets in a tizzy, particularly in Europe. So further, some countries mandated carbon taxes, trying to have very aggressive climate transition targets, such as specific dates to say that from X date, we will stop production of internal combustion vehicles in favor of electric vehicles. Or some countries actually put dates by mandating households to be able to replace their gas boilers and heaters with electric ones. The proposals received a lot of backlash from the people. Now, this is largely because against the backdrop of higher inflation, lower wages, lack of new job opportunities, and perhaps an unrealistic transition targets without concrete plans on how we were going to finance this transition. And we know now that governments that are not aligned with the realities of their voters get voted out. So timing and the pace of transition is as critical when one is looking at transition to low carbon pathways. We have to appreciate that in India, we took a very realistic stance by committing to be net zero by 2070, but still we had in fairly ambitious interim targets of 2030 as well. Now, economic realities have also changed. We know that there's been a global slowdown in growth. The question still remains is who will fund the green transition? The global south feels that the developed world needs to acknowledge the importance of a just transition and bear their share of contributions to the loss and damage funds for the developing countries. Now, some global asset managers that were managing trillions of dollars of sustainable finance investments are also de-emphasizing the role of ESG to prevent litigations under the guise by saying that the mandate of a fund manager is to maximize profits, especially if they're managing funds of retirees. Now, many of the large asset managers in recent period have withdrawn from their net zero alliances. Yet, we have a fair bit of other fund managers that also say that we have a responsibility and we are accountable for delivering a robust climate stewardship strategy. And ultimately, we need to deliver value for investors. So the divide, again, is very, very clear. Geopolitics, too, plays a significant role in how ESG policies are shaping up. It's true that distrust amongst countries today is heightened. It's also true that new wars will be fought on technology supremacy. So countries are shaping new policies based on self-reliance in critical sectors and reliance on maybe select critical trusted partners, and that has replaced the globalization model. Now, the advent of artificial intelligence calls for an exponential increase in energy. While decarbonization incentives are imperative, the reality is that most countries are likely to run two parallel energy systems while continuing with fossil-based fuels, while also increasing capacity in clean energy. India is a clear example of this. We've seen substantial increase in investments in installed renewable energy. So today, in terms of installed capacity, 47% is non-fossil fuel, 53% is fossil-based. This is an encouraging trend to see in energy mix. Yet, the reality is, in terms of electricity generation, 72% is still generated from coal. Now, intermittent generation of renewables, grid integration challenges, seasonal variations as far as renewables are concerned, transmission constraints, and energy storage are still some challenges that we need to overcome. Again, electricity is a complicated subject in India, largely because it's a concurrent subject, which means it falls both within the ambit of the central and state governments. And India needs to ramp up investments in its grid infrastructure and also ensure financial health of its state electricity boards to be able to better meet the growing energy demands. So for a country like India, what does the future hold to ensure sustainable development? Now, despite the recent slowdown that we've seen in GDP growth, where GDP growth has slowed down to an estimated 6.4% of GDP compared to 8.3% that we saw in the previous year, India still remains the fastest growing major economy. And yet, to fulfill the ambitions of a Viksit Bharat, which is having India as a $30 trillion economy by 2047 and raising the per capita income from 2,500 to about 18,000 US dollars, India requires to have bold reforms and accelerate its GDP growth to nearly 10% per annum. And as they say, a lot of India will still need to be built, and it needs to be built sustainably. So today, in evaluating any project, environmental and social due diligence is becoming more and more compelling. Even the Securities and Exchange Board of India, SEBI, has, through its BRSR, mandated detailed disclosures of ESG for the top 1,000 companies by market capitalization. Now, what is good about the BRSR is that it is an indigenous framework. The key challenge is, however, is to widen this to many more companies and to also include companies that are in the value chain. This task will not be easy because it entails additional costs, compliances, and building up of requisite talent. So India will also need better mechanisms to record this kind of data. And what we need is to have ESG repositories, which is akin to the way we've seen credit bureaus grow today. So for financial institutions, financed emissions is possibly the most critical. This means that for every loan that a financial institution provides, what is the carbon footprint as a result of that funding? Challenges are that the country still does not have India-specific environmentally extended input-output models. But there is hope. These are being developed, and these are being developed by well-reputed institutions. And if we have standardized models for emission factors across different industries, it'll go a long way in enabling banks and financial institutions to credibly disclose their financed emissions. So the emphasis on transparency, consistency, and honest reporting on ESG parameters cannot be overemphasized. It's equally imperative that we ensure sufficient capacity building in ESG and the climate space through trainings, networks, technical collaborations, information sharing, and exactly what this whole week has been all about. We have to appreciate that we in India have a lot to be optimistic about our future. We have to embrace change, but what we have to recognize is that there are many opportunities in the sustainable space. I hope this week has been fruitful for all you attendees. And as they say, by learning, you will teach, and by teaching, you will learn. So it's been a pleasure to share my views. I'm happy to open up the floor for questions. Thank you. I think everyone's had a very, very long evening. Mosmi, are you there?
Hello, ma'am.
Yeah, hi.
Yes, ma'am.
Yeah.
Ma'am, I have a question.
Yeah.
Ma'am, as you have mentioned that that financial institutions are the main players who will be financing that transition gap. So, ma'am, what can be the most important factors or components which banks or financial institutions should look into when making that transition financing for the industries or sectors?
Sure. That's a very, very pertinent question. It's a very good question. The one thing you have to recognize is that the biggest mistake is for banks to just blindly chase green assets. What we are doing is that you still need to be using your same credit assessments. And what we are doing is adding this layer of environmental and social governance to tell people who are borrowing money that it's not just a question of being compliant with existing laws, but you need to go beyond this. The very fact that, I would not want to say, is it just, you prioritize green buildings or you prioritize renewable energy or you prioritize industries to be able to transition. Now, if you're a leading bank that has been lending to the corporate sector, it's also important to be able to position yourself to be preferred funders to enable institutions to transit towards cleaner pathways. So there isn't a straightforward path to this. You still need to be prudent in terms of your lending, because at the end of the day, the responsibility of a bank is to ensure that its asset quality remains pristine. But these are some of the new age challenges, but they're also opportunities. These are opportunities that we didn't have about 10, 12 years ago. And that's where I think there's a lot of enthusiasm. There are a lot of startups that are also working very, very closely in the sustainability and climate change space. So I think there are a lot of opportunities available. But each one will have to be evaluated on a case-by-case basis.
Ma'am, currently is there any such thing like any credit rating model or any credit rating framework which is actually incorporating that factors, that traditional risk factors and that environmental factors within banks itself?
So there isn't a standardized framework available as of now. So a lot of banks are developing their own internal frameworks. And so if you actually read the annual reports of banks today, you will see that almost every bank will talk about their strategies. It isn't a one-size-fits-all framework at this juncture. But we are trying to work towards getting a lot more standardized on a lot of parameters. But it is still at an evolution stage. So I think in a way, it's also good to allow banks to be able to do frameworks that work best for themselves at this point in time, while new regulations are also in the making.
Ma'am, also that banks are making that those investments, like they are making that sustainable bonds, green bonds investments, and investment in renewable energy resources. But while at the same time, in their credit exposure to industries, they are the major lenders of fossil fuel reliant industries. So isn't it that like they are talking like they are doing sustainable practices, but in actual sense, they are not walking the talk?
No, I don't think that is the case. The very fact that we have to be open and accept the fact that we are an energy deficient country, the demand for energy is huge. And today, if every bank comes out with a policy to say, okay, we will not lend to any thermal plant, none of us will have electricity. So you have to be very, very conscious, nuanced about what state you are in at different points in time, and being honest about it. Yes, it's true that certain groupings of assets is not very clear because India does not have a green taxonomy at this point in time. And I'll give you a very simple example. So you know that the sovereign had come out with the green framework when they were raising sovereign green bonds. Over there, they said the green asset can be categorized. Let's say if you have a renewable asset, it can be classified as a green asset. But then, if you look at the ICMA principles, which are the international principles, they will say that 85% of the cash flows have to come from renewables, which means that if you are lending to, let's say, a thermal power plant, which is transitioning to green, it doesn't qualify as green. So globally, the standards are varying. And at the end of the day, India has to do what is right for its economy. And I think a lot of countries are recognizing this. You've seen some of the Scandinavian countries, which are the flag bearers in terms of renewable energy. But where did those funds come from? Those funds came from oil and gas. So we have to be realistic in what we are doing, at the same time recognizing that these risks are rising in the system.
Thank you, ma'am, for answering my question. I think we have other question from participants. Someone has raised their hands.
And feel free to just express your views also, because what I thought was important to do was to give you a realistic position of what is happening in this space. So, I'd be more than happy to hear from your views as well.
Participant can unmute themselves and ask the question.
While also marking your attendance, everybody. I know how critical it must be, and I know how tired you all must be on a Saturday evening, but it's really wonderful that you all are all here.
Ma'am, I have another question. Like, companies are making their disclosure on the basis of which the banks and financial institutions are giving them the credit. Maybe it is and by incorporating environmental factors also. So, how can banks get to know the thing that the companies are actually making their efforts and doing it and not just disclosing it? How that they tackle that greenwashing part?
Yeah, very interesting question. And I'm glad you asked this because what we are seeing today is that the banks that are proactively going to customers and saying that as part of our overall credit assessment, we will do an environmental and social due diligence. Now, maybe about 5 years ago, a lot of companies would say, why are you making us go through this? It's not required by law. This is extra effort. We may not want to share this data. Today, I don't think this conversation, I think everybody recognizes the importance of ENS due diligence. But having said that, you will see there's a vast difference in companies and the ability. So not all companies are able to record their carbon emissions, for instance. And it is critical and it's in the interest of the banks, because the better the scope 1 and scope 2 emissions of the people that the bank lends to, the better will be the quality of the financed emissions that the bank has to report. So for instance, last year in the integrated annual report of HDFC Bank, what we did is that we looked at our overall loan exposures, and where we found that our customers had provided us scope 1 and scope 2 data, we went ahead and calculated the financed emissions because we were really certain of those numbers. And we use the PCAF methodology. And the PCAF methodology is the Partnership for Carbon Accounting for Financials. It's a methodology that is fairly transparent in being able to record your financed emissions. But the problem is when the scope 1 and scope 2 emissions are not available, you need to use proxies. And this proxy could be, let's say, like an emission factor of an industry. It could be using other factors, let's say like a square footage area if you're recording, let's say, emissions from green buildings. But the fact is the quality of that data is still fairly wanting. And this is why we need to be able to jointly develop models which are India specific to be able to do these calculations better.
Thank you, ma'am. I have another question. Is there any add-on advantage for banks to give this sustainable loans as compared to the traditional loans?
Yeah. The point initially, we all thought that once we had this mandate of the environmental aspect attached to it, there was something called a greenium. Now, what does the greenium mean? A greenium means that you will be able to raise funds at a slightly lower cost, and the investors were happy to accept a lower rate of interest, provided it was actually going in and on lending was happening for the green sector. But the reality is, even when the government of India raised green bonds, it couldn't get much of a greenium, which means that it was able to raise interest. They did a 10-year green bond, and that was just 2 basis points lower. Now, when you have a green bond, there are a lot of other compliances that you need to do, because you need to be able to record what utilization has gone in for those green assets. And the reality is that the greenium does not exist. So we have to accept the fact that whatever lending that we're going to do in the green space is not going to come at a concessional rate of interest. So it's very hard for a bank that is not able to raise resources at lower costs to be able to pass on those benefits.
Thank you, ma'am, for answering my question. I think we have a question from Pooja Kaushik. Ma'am, you can unmute yourself. Pooja, ma'am, are you there? I think,
Yeah.
I think, ma'am, she's not here.
Okay, no problem.
Um, ma'am,
I think,
also, there
I
is.
think there's another person also there. Neha, I think, has raised her hand.
Yeah,
Uh,
ma'am. Hello,
Hi,
good
hi, good
evening.
evening.
Hi, this is Dr. Neha Onial from Tula Institute. Ma'am, any suggestions for the students, like how can we shape them to live their life sustainably in the campus area?
I think the one thing that we have an advantage is that the younger generation is definitely a lot more attuned and a lot more sensitized to these kind of issues vis-a-vis the older generation. But at the same time, um, a lot of what we learn in the classroom with the emphasis on sustainability means that once they come into the job area, they are already sensitized on very simple things, whether it is in terms of energy saving devices, whether it is being responsible for your own surroundings and your own environment, because this cuts across whether you're looking at day to day living, what kind of fuel, what kind of vehicle you want to drive. Um, the younger generation is looking at clothing being sustainable. So it cuts across almost every aspect of one's life. But the fact that they learn this in school means that they come out into the workforce already sensitized, accepting that there is a crisis that needs to be fixed. And also, we as employees are spending a lot of time in capacity building, building up requisite talent. And if you get that ready made force coming, and this is going to be an irrespective of which profession you choose, I think the sustainability aspect is going to be there in any career going forward. So yes, it's going to be something that is an evolving space.
क्या कर सकते हैं आप दोबारा कर सकते हैं कुछ
But the most critical part
बोलना कि
is
हमारे पास
really
टेक्निकल
the
ग्लिच हुआ है
measurement of the emission factors.
हाँ बोलना कि मैम हमारा कुछ टेक्निकल ग्लिच था हम क्या करें
But it's wonderful that you all are spending this time in order to then spend time with the students to be able to sensitize them on these issues.
Thank you, ma'am. Thank you so much for answering my question.
Ma'am, we have a question on the chat box. Like, SME face huge financial crisis and even banks deny them financing due to their shortcomings. What could be a middle ground from the financial institution side to SMEs based on Indian diverse context?
No, that's very right, because SMEs, at the end of the day, the MSME segment is the backbone of the economy in terms of employment generation, in terms of the manufacturing sector. But
पेपर का
I think somebody is not on mute. But what is really critical is the ability to ensure that the MSMEs get paid on time. So there are regulations in place. There are also the government. If you look at the recent budget, the last two budgets have been emphasizing on the importance of the MSME segment. There is now a credit guarantee fund being set up. During COVID time, there was a lot of support given to the MSME segments. And when we're looking at the MSMEs from a sustainability point of view, that is why the capital markets regulator, SEBI, is encouraging all companies to now start reporting ESG data for their value chain partners. So it is going to be something that companies need to take that onus to be able to work with the MSME segments. But as I had mentioned in my talk as well, what we now need to do is create repositories and make it easier for MSMEs to be able to report a number of their ESG parameters. Largely, they will need a lot of help in reporting their scope 1 and scope 2 emissions, because that requires a little bit of technical expertise. And look, large companies have the ability to hire the right talent, have to be able to work with consultants to be able to get this expertise. To expect a small entity to do this is something that we all need to be able to build up a lot more of training, lot more of capacity building to be able to ensure that at a systemic level, we are able to have this data in place.
Thank you, ma'am. Ma'am, there is another question related to SME only. Supply chain finance is a triadic concept where the lead roles are played by larger corporates and financial institutions. What initiative could be taken to give the bargaining power to the SMEs?
Well, it comes back to the same thing, right? I mean, if you're really looking at the SMEs are really putting a number of your products, and it's the larger companies that is assembling these products together. So most certainly the supply chain financing, the MSME segments, these are the backbone of your economy. And you've got to be able to have, in fact, the RBI, for instance, mandates certain priority sector lending towards certain segments of MSME. We need this for our economies. So you need to ensure this. There are also the TREDS, which is the trading platform today, where an MSME can come and discount their bills and be able to get the money upfront. So there are various financing mechanisms that are being put in place. Every company now needs to disclose in their notes to accounts to say that what is the pendency date of MSME vendors. So today there is a regulation that mandates you to make all payments to MSME vendors within 90 days. So regulations are being put in place, but at the same time, you recognize that what is not changing is micro enterprises are not easily being able to become small enterprises, and the small enterprises are not easily being able to become medium scale enterprises. And that cycle is what we really need to break out of.
Thank you, ma'am. That's a really nice answer, actually. Ma'am, there is another question like, what steps can banks take to ensure a just transition for workers and communities affected by the transition to a low carbon economy?
Sure. So this comes back to the same point, the question that you asked initially. Like if a bank comes out and says, look, we will not lend to any bit of the coal sector, we will not lend to the thermal sector at all, maybe the ESG scores might raise to an A grade. But what will it do for the lakhs of workers? We still need to reskill workers. We are still responsible to be able to, as a government, you can't just abandon these large industries overnight. And at the same time, you also need to ensure that you have a steady supply of energy available for the country. The just transition is saying that you cannot mandate the kind of targets that you have for certain developed economies. And it has taken us institutions a very long time, especially when we were explaining to foreign shareholders that some countries have legally binding targets and they have a date of net zero at 2050. That was not the case with China. That cannot be the case with India. And I think we have proven correct that you need this transition, but you need the transition to be funded. Look at what happened at the last COP. I mean, India was one of the most vocal participants to say that it was just too distant, too little, that the developed economies were not taking their fair share of the load, even on the loss and damage funds. And half the divide that is happening is that the developing countries have a much lower per capita emission compared to the developed countries. And the big question is, who pays? And that's something that we haven't been able to overcome as yet. So countries are then deciding that, yes, in this whole scenario, we now need to start being what we call as the whole Atma Nirbhar movement or the self-reliance. It's not just India that is doing it, but having energy security is something that is very, very critical for a country from a geopolitical stance, from an economic stance, from a finance stance as well.
Thank you, ma'am. Ma'am, that ESG rating providers and the credit rating agencies, what can be their role in for sustainable financing?
I think the ESG frameworks are still evolving. The rating frameworks are still evolving. What I found a little difficult to understand is that we've had credit ratings in the system in India, credit ratings I'm talking about, for maybe about nearly 40 years now. There have been four major rating agencies. But when you look at the ESG rating agencies, today we have about 15 licensed ESG rating agencies that have been all licensed by SEBI. I think the space is hugely crowded. It is going to be something that will evolve over a period of time. But the way I would prefer to look at it is not to put ESG ratings outside in a box separately. You have to look at the financial parameters, the non-financial parameters, and then arrive at a combined rating. But then that's my personal view of this.
Ma'am, but how far they're reliable actually? Because I have came across
The reason why they're not reliable is because the E, the S, and the G have different priorities for different industries. And that's why the next stage of the BRSR report will move towards sector-specific reports. And that's what the trend is going to be in the near future. So the reason why you have so much of dissonance across the ESG rating scores with the same company is that one ESG rating may have a higher weightage of environment, one may have a higher weightage on governance, and therefore when you look at the combined scores together, the data starts reading differently. Which is why I've always said that the best way for companies to do is for themselves to be able to talk and bring their ESG story out directly to the investors rather than relying on third-party data. And therefore, even comparing different scores doesn't always give you the right picture.
Thank you, ma'am. Ma'am, other than the financial institution, like the major banks, we have NBFCs and microfinancial institutions. How can they cater to this sustainable finance concept, or what can be their role actually?
No, actually, the NBFC sector, the MFI sector are very, very critical components in the financial sector because banks don't have the same kind of reach, don't have the same kind of niche products necessarily that NBFCs or microfinance entities have. But having said that, especially the MFI sector is also vulnerable to a lot of other external factors. Let's say there could be state politics. State politics could turn around and say, look, you don't need to repay your loans. And we are constantly seeing every now and again, you're seeing a large number of MFIs often getting into trouble because, the repayment cycle doesn't happen. What's also happened in the system, and this is something that was good that the RBI pointed out, was that the indebtedness of this segment was increasing substantially. And what was happening is that one borrower had multiple borrowings and therefore was just not able to repay their loans. And this is a cycle that is called evergreening, which means you keep borrowing to repay your earlier loan. And microfinance is supposed to be used to be able to help the small entities and the individuals to be able to get income generating activities from there. It's a complicated space. But having said that, I think the NBFCs, the larger NBFCs are most certainly looking at ESG. They are reporting these. It's the smaller entities and the smaller companies. So what SEBI is now going to do is move the ladder from the top 1,000 companies and slowly start getting more and more companies to start reporting these. There's a huge difference between listed entities versus unlisted entities. The unlisted entity space, where a large number of MSMEs are there, that is also a space that will need a lot more work to be able to report these numbers.
Thank you, ma'am. Pooja, ma'am, do you have any question? You have raised your hand. Ma'am, are you there? I think she's
Yeah.
not there.
No.
Ma'am, another question from my side is we have that calculation for the environmental part, like we can look into how emissions and for usage for the environmental part. How can what is the due diligence part banks can do for the social impact, for measuring the social impact of an industry?
Yeah, well, the social impact side is recognizing, and this is really very important. What are the parameters that you're looking at on the social side? The first parameter is looking at human rights, labor laws, child labor. These are very, very essential factors, and the reality is it is still there. And as a responsible institution, it is up to you to be able to do that due diligence. You have to be able to convince yourself. Look, any entity will turn around and say, I don't use child labor. They'll give you an undertaking. That is not sufficient. You have to do your groundwork. You have to be able to ensure that these are basic essentials that are there. Take the case for a developer. A developer needs to follow certain safety norms. Those, if you're lending to a developer, you've got to be able to ensure that it's there. Certain states mandate that the labor needs to actually have a creche facility available on site. These are existing regulations that are there. These are the checks and balances that institutions that are lending, that ascribe a value to responsible lending, need to do this. So it is a lot more effort to do, but these are really important factors.
Thank you, ma'am, for answering my query. We have another question in our chat box. Is it possible for developed countries to achieve true sustainability while still addressing the need and development aspirations of rapidly growing developing nation? Or will this lead to a zero-sum scenario where one group growth is at the expense of another environmental well-being?
Look, I don't really have a clear answer. The simple reason is that there's so many shifting paths to this that is happening. So for a long time, for instance, Europe was the leader in terms of renewable energy. But what happened with the Ukraine war? Prices of energy just suddenly shot up. There were sanctions across for the EU countries. Where were they going to be able to source them as they were approaching towards winter, which they needed their heating? So a lot of these, if you look today in what's happening in Germany, there's a huge backlash against renewables. These are shifting grounds that are constantly happening. I think there has been a reality check on what the kind of ambitions that were set out earlier, let's say post the climate accord, to what is happening now. But I think every country will now need to be able to take its path forward as keeping in mind what is best for their economies. I don't think there's a clear-cut answer. I understand where you're coming from. The fact is that developing economies will have a lot stronger moat around them because they have the financial resources to do that. But this is something that is going to be a constant wait and watch. Policies have to keep evolving for the day. Today, we're supporting EVs. Tomorrow, if the government will want to continue supporting EVs, we don't know. We have to keep, and that's the reason why it's so important to stay abreast with what is happening globally as well as what is happening in our own economies.
Thank you, ma'am. Ma'am, we have another question, like how can we link this sustainability concept to this entire supply chain?
Well, it's really about stepping down the rung. Why are we saying that we need to widen and not just look at, let's say, like the top 1,000 companies today? The top 150 companies have even got all their ESG data reasonably assured, which means we've gone through a full-fledged audit on a number of what they call as the core BRSR. But when you're looking at an economy, you can't have certain pockets of the economy that are following ESG norms and certain that are not. These are systems that need to be put in place. Look at it. I'll give you the easiest example to look at it is how did a lot of computerization spread across the system? Three things are really important when we are looking at widening the net as far as ESG is concerned and widening and having a larger number of players that are able to give this data. Affordability, accessibility are the two most critical factors. So it is something that will evolve over a period of time. I think we need to have a lot more of new institutional mechanisms in place. We will need to have repositories that, let's say, a small MSME can go across and say, look, these are the 12 months of my electricity bill. Help me calculate my emissions. This can be done through a lot more of automation, for instance. These are tools, these are ideas. Young people across as students, I'm sure, will come up with many, many more solutions as we go forward.
Thank you, ma'am. Ma'am, another question is like there is a report came. There is actually framework came in 2017 in for the banks, that voluntary framework for responsible banking, which is in line with the UN principle for responsible banking. How far the banks have actually incorporated it in real terms?
No, you know what? The Reserve Bank of India has issued two sets of guidelines, one in 2022, if I recall correctly, and one in February of 2024. But both these were draft guidelines, so they were not finalized. And the reason why, as I had mentioned earlier, is that the Reserve Bank of India is still waiting for the Government of India to define the green taxonomy. Once that gets defined, the RBI will then be able to come and finalize their guidelines. But the RBI is working very closely with banks. In fact, they've done a number of exercises with the banks where the banks have provided data. The RBI themselves have run models, their own models. See, in a bank also, it's very important to understand that risk management is very, very critical. And one of the things that the RBI mandates is that you need to be able to have something and explain what your model risk is. So whatever the underlying assumptions that you are using, let's say in using climate risk scenario analysis, you need to be able to explain the underlying assumptions. At this point in time, the models that were available in the international markets had, let's say, a transition timeline of 2050. They were not customized to a 2070 net zero targets that India has. So there are inherent problems as far as the data is concerned. Another issue I'd give you, let's say we all understand what physical risk is, and the RBI and the TCFD framework also asks banks to measure what kind of physical risk they have. The underlying data is of what you're using is not common. And I'll give you a simple example. Let's say if you have an exposure in the state of Maharashtra, one bank will say it's a coastal state, the risks are rising sea levels. One bank will say, it could be subject to drought. Another bank will say, this particular locality is subject to floods. Now, how are we going to make sense of this kind of data? Unless we have a common database, and then banks start using that common database to be able to map their exposures based on something like, let's say, a PIN code level data. There's a lot of work happening in terms of getting better data. There are satellite imageries. There are companies that are working on being able to get better climate data. But once that data gets standardized, I think it would help a lot of banks in terms of those reportings as well.
Thank you, ma'am, for answering our queries. Participants, if you have any question, kindly unmute yourself, or otherwise we can wrap up the session, I guess. Anyone? Ma'am, I think they don't have any questions.
Yeah.
So we can put the session here. Thank you, Anjali ma'am, for considering our invitation. And that's really an insightful session. And I get to know many things. And obviously, all of us get to know many things.
No,
Okay,
as
ma'am,
I
there
said, this
is.
space is constantly evolving. The only way you can stay relevant is to keep reading what is happening across the globe, because this cuts across, all of our lives. But thank you so much for inviting me. It's been a pleasure. All the very best to all of you.
Ma'am, there is one last question, I
Sure.
guess, in the chat box.
Yeah.
What is the optimal balance between individual responsibility for sustainability and the need for systematic change by government and corporations?
A really tough one. Whoever asked this question, can you help me get an answer? No, I think at the end of the day, we all have a shared responsibility. I really don't think that it is just to say that the governments do their bit and citizens don't. It's a tough question to ask, but it's something that all of us need to think for, and especially think about because of our future. But great question, and I'm sorry I don't have an answer right away, but I would really think we all have to carry our weight on this.
Thank you, ma'am, for the answer. And thank you, ma'am, for coming. And that's a really nice session and very insightful. Thank you.
All the best to all of you all. Good evening. Bye.
Good evening. Participants we will resume in 6:30 for our overall feedback session.